Hello everyone, I'm Nova Lui, Head of Investor Advisory at RHB Bank. Thank you for joining us for our Q2 2025 Fund Discovery Ideas. Emerging market generally outperform developed market over both 1 and 3 months period, with notable exceptions like FBM KLCI decline. Developed market, particularly US indices like Nasdaq and S&P 500, experienced headwinds, potentially driven by political instability and the impact of renewed AI competition from China on the US tech sector. The resilience of emerging markets, especially China and India indices, suggests a shift in investor focus towards growth opportunity in this region. On the 1-month top gainer, the Nifty India Index, the strong performance likely reflect India's economic resilience, foreign investment inflow, and robust corporate earnings, particularly in the IT and financial sector. This is supported by positive economic indicators and government policies boosting investor confidence. The 1-month top loser Nasdaq down 8.14% also suggests ongoing challenges in the US tech sector, possibly due to high valuation and AI competition from China ever since the introduction of DeepSeek AI, which was created with a far lower cost and lower end chips. In contrarian, which HSCEI is up by 17.58% in the same month. This significant gain indicates stabilization in China's economic policies, stimulus measure, and improved investor sentiment towards China's equity listed in Hong Kong, driven by recovery in the China stock market. HSCEI is also heavy in Chinese technology stocks. Let's take a look at the unit trust industry fund flow for the past 1 quarter and 1 year. Malaysia ringgit denominated bond fund, particularly bond ringgit, has emerged as the leading recipients of investors' inflow, buoyed by their stability in a steady economic climate. Domestic bond funds continue to draw demand, attributed to their lower risk profile, predictable return, and appeal as a hedge against global interest rate uncertainty through local currency exposure. Concurrently, the US dollar denominated global mixed asset fund dominated inflow with mixed asset US dollar balance global and mixed asset USD flexible global, securing ringgit 569 million and 463 million respectively in the last quarter. Over 1 year, these strategies attracted 2 billion and 1.9 billion respectively, underscoring investors' preference for diversified global exposed portfolio. This trend reflects a pursuit of stability, currency diversification, and tactical flexibility amid heightened market volatility. Sector-specific fund also saw inflow with information technology with a 472 million inflow in Q1 and US equity fund capturing inflow, signaling targeted confidence in the tech growth and US market resilience. However, these inflows were concentrated in recent quarters. Notably, Malaysian investors have adopted a defensive stance, reallocating from equity and small cap fund into domestic mixed asset vehicle. This shift highlights a broader pivot towards capital preservation and balanced risk exposure in uncertain markets. Over the past year, Asia Pacific and Asia Pacific ex-Japan equity fund lead the combined outflow at 3.3 billion ringgit. Greater China focused equity vehicles face combined net outflow exceeding 1.5 billion ringgit over the past 1 year, underscoring investor concern towards China's economic headwinds and geopolitical risks. Notably, domestic equity fund displayed diverging trend, while Malaysian equity market recorded net inflow over the past 1 year. However, the last 1 quarter has shown outflow, a reversal potentially tied to recent scrutiny over semiconductor exports to China. This suggests recalibrated positioning amid evolving sector-specific risks. Asset allocation shift towards capital preservation are evident. Equity and mixed asset funds dominated the resumption, while bond funds saw relatively muted withdrawal. Meanwhile, within the fixed income space, only Asia Pacific appear in the top 10 outflow, which this one has 439 million outflow. With huge rally in the gold prices, funds in gold and precious metal equity funds recorded modest outflow, likely reflecting tactical profit taking rather than to abandon the safe haven assets. As we explore compelling fund idea for Q2 2025, our investment strategy is anchored around three core themes. The first is built for the storm, strategies that benefit from market swings, focuses on funds designed to thrive amid volatility and uncertainty. A standout in this category is RHB Global Equity Premium Income Fund. This innovative fund leverages on option overlay strategy to capture equity premium, while simultaneously generating consistent income from dividend of high-quality blue-chip stocks. Its dual approach allows the fund to benefit from sustained market volatility, offering investors both downside protection and upside participation. This underlying portfolio is actively managed and diversified across sectors, poised to benefit from a broadening in corporate earning growth, further enhancing resilience. With a targeted annual distribution yield of 7 to 9% paid monthly, the fund delivers a compelling alternative to traditional income-generating assets, balancing yield, capital appreciation, and risk management. It's a structure as a feeder fund into JP Morgan Asset Management actively managed ETF ensures global equity exposure with low volatility, meeting the growing demand for diversified income stream in today's dynamic market environment. Another fund aligned with this theme is MAMG Systematic Asia Pacific Equity Absolute Return Fund. This market-neutral long-short strategy is engineered to deliver positive return regardless of broader market direction. By accessing an extensive investment universe across both small-cap and large-cap companies in Asia Pacific region, the fund seeks to exploit inefficiencies and capture alpha opportunities. Leveraging advanced AI technology and BlackRock's deep expertise, the fund dynamically adapts to evolving market conditions, positioning itself to outperform in both bullish and bearish environments. Together, these funds exemplify robust strategies for navigating market swings, offering investors the potential for steady income and capital growth even amid heightened volatility. Below is the return of this fund for the past 1 year, which has shown consistent performance on month-to-month basis. The second investment theme is dynamic by design. Absolute return strategies with flexible exposure highlights the RHB Dynamic Artificial Intelligence Allocator Fund. It's Malaysia's first AI-driven multi-asset fund with digital asset exposure. This innovative fund leverages proprietary AI model to dynamically allocate across equities, fixed income, and digital asset ETF, aiming for long-term capital growth while actively managing risk. The AI-driven approach eliminates human bias and emotional decision-making to adjust asset allocation between 0 to 100% based on market condition. Back-tested results indicate that this strategy has outperformed direct digital asset investments, offering higher total returns with lower downside risk. The fund invests in digital asset ETF managed by established firms, providing diversified and institutional-grade exposure. With over 80 data sets including macroeconomic and technical indicators, the AI system continually rebalances the portfolio to capture opportunities and mitigate risk in fast-changing markets. As digital assets gain broader institutional acceptance, the RHB Dynamic AI Allocator Fund offers investors a sophisticated, adaptive solution for portfolio diversification. While digital asset exposure may be new for some, a modest allocation should suit investors seeking innovative, risk-managed strategies in today's evolving landscape. The third investment approach, patient and precision, buying quality stocks at dip. emphasizes a disciplined approach to build a resilient portfolio by gradually accumulating high-quality stocks, particularly in the sector tied to AI and emerging markets like India. This strategy is rooted in selectively focus on companies with robust fundamentals and innovation-driven growth prospects, ensuring that investors are well positioned to capture future market opportunity as they arise. A prime example is the RHB US Growth Fund, a diversified multi-sector equity fund targeting the US market. With recent market volatility driven by US tariff actions, investors may find attractive entry point to accumulate leading growth stocks, especially those benefiting from the ongoing AI revolution. AI spending remains strong, fueling sustained demand for semiconductor and related technology and positioning selective US companies for long-term outperformance. Leading AI names, chip makers, and technology giants continue to drive innovation and earning growth, making them compelling additions for patient investors seeking exposure to secular trend. Emerging market, the Manulife India Equity Fund offers exposure to India dynamic growth story. For the first time, domestic ownership in India equity has surpassed foreign holding, reflecting robust local demand even amid foreign outflow. Recent regulatory change such as increased foreign investment limit aim to attract more overseas capital and support market resilience. Managed by a joint venture between Mahindra Finance and Manulife, the fund leverages deep expertise to identify quality opportunities in India's rapidly expanding economy. India is also more insulated from US tariff compared to China, thanks to lower tariff rate and the strong service sector, further enhancing its long-term investment appeal. By strategically accumulating quality stock in these sectors, investors can benefit from innovation, economic growth, and favorable market dynamics over time. Finally, for conservative investors seeking stable income and capital preservation, considering exposure to Australian dollar denominated asset is a compelling option. Currently, the Aussie is trading near 5-year low against ringgit, presenting an attractive entry point. As one of the strong G7 currency, the Aussie offers both currency stability and potential upside from currency appreciation over time. Investing in AUD bonds can provide dual benefit, steady coupon payment, and the possibility of capital gains, especially if interest rates in Australia are cut in the near future. A well-structured portfolio with AUD bond exposure can deliver consistent monthly income with average coupon yield ranging between 6.5 to 7%, making it an appealing choice for income-focused investors. Below an example of a portfolio of financial institution bonds that is designed by allocating to diversified AUD financial institute papers, which allow investors to receive coupon on monthly basis while positioning for potential capital appreciation. Given the current currency valuation and the macroeconomic outlook, this strategy offers a balanced approach to income generation and risk management. Thank you for joining our podcast today. I hope my insight has provided valuable information to help you make more informed investment decisions. Please view our market insight material from RHB Merge website. See you again in the next podcast series.